All right, guys. So I'm gonna get started. So today's session we focusing on financial statements. And granted that classes, exams are right around the corner, I thought it would make a bit more sense for us to jump straight into doing some questions, and we look at the topic through questions as opposed to slides. So I've changed the delivery a bit, right? You guys will let me know if it works for you guys. So Odlin shared some questions with me. I'm gonna look at those, and then if we exhaust those, then I'll pull some questions, similar type of questions, from the resources that I have available. So I want to show you your approach to a financial statements question. Now, at your level of accounting, you are generally required to prepare a trading and profit and loss account along with a balance sheet. And there are some adjustments or notes that would be provided with the question, right? Nothing too extravagant. Basically, the notes would usually provide stock at the end of the year. So the closing stock is always inside of the notes. When you see stock inside of the list of balances, which is presented in the form of a trial balance, we talked about the trial balance lastly. The stock here, if you look at the question, right, this is at the year end 30th of June 2005. This is an opening stock here, right? This is what the inside of the list of balances. This will always be your opening stock. So if you want, you could label that as your opening stock. I usually put OS. Other people might call it inventory. I call it stock. Works the same way, right? Now, there's a method that I would usually show my students to use in approaching not just financial statements, but accounting questions on the whole. When we are given a set of balances, I think it's easier if you take a few minutes at the beginning and you identify the figures that you have in terms of where you're going to be using them and any adjustments that should be made. You do working first. At least this is how I was taught to approach financial statements, right? So let's go through the list of balances. Sales. Anybody knows where we're going to be using the sales figure? Is it going to be in our trading account, the profit and loss section, or the balance sheet? Where would we be using sales? Samantha, you want to give it a try? But the sales figure go in the trading part of the profit and loss account, trading and profit and loss account, the profit and loss section, or is it a balance sheet item?
The trading and profit.
Correct, right? And what I would usually do is I will separate it because although it's one account, there's some figures that is specific to the trading part of it and others that will go in the profit and loss section. So sales is our trading item, right? We will find it inside of the trading account. So too is purchases. Now, carriage on sales, also called carriage outwards because it's transport to take the goods out to the customer, is an expense. And all expenses and income, right, will go in our profit and loss section. So I will write P and L next to this one. Discounts allowed is also an expense. A discount allowed is a form of discount that you will give to a customer, usually because they are a loyal customer, or maybe the volume of goods that they will usually purchase from us. You're trying to build a relationship with them. So for example, if I am a hardware and I have contractors coming to purchase goods from me, I would want them to come to me because they may be in the process of building 100 houses. So when they're coming to buy material, they're not coming to buy one bucket of paint or one bag of cement. They might be taking pallets of paint or pallets of cement. So that's a lot of business. So I might give them a discount on their purchase. So that way they'll say, you know what, I'll patronize this particular hardware because when I go there, I could save a few dollars because I'll get some discounts on the things that I purchase. So discounts to me as the business owner is an expense because if I should receive $700 for an item and I'm taking 620, it means that I'm losing $18. It's an expense to me. So discounts allowed, similar to carriage on sales, is a P&L item. Loan interest is another expense, and that goes in the P&L account. Well, office expenses is self-explanatory. We could see the word expenses, so we know that that's going to go in the P&L account. So is salaries and wages. So is bad debts. Provisions for doubtful debts is also a P&L item, right? Because that's an expense. Loan from P-Prints though. This is not an expense, nor a trading item. This is actually a liability. And liabilities will go in our balance sheet. Capital, another balance sheet item. Drawings, another balance sheet item. Sales and purchases returns. So sales and purchases returns will go in our trading account. But sometimes in some questions, what they try to do to test your understanding of balances, they will combine sales and purchases in one line. So now you need to be able to discern which of these figures is a sales return and which of these figures is a purchases return. Now, there's an easy way to rationalize this, right? Now, when people are returning goods to us, this good is stock, right? And we all know that stock is an asset. Everybody agree with that? Give me a thumbs up if you agree that stock is an asset. So we agree that stock is going to fall under the umbrella, right? It's going to fall under the umbrella of assets. I don't laugh at my drawing, right? I just try to draw something. Look like an umbrella. It falls under the umbrella of assets. And what do we know about assets? When assets increase, we will debit it. And when assets decrease, we will credit. Similarly, for accounts where there's decreases in assets or increases in assets, their closing balances will reflect that. So think about it. Sales returns means that the stock is coming back to us, right? Everybody agree with that? Sales returns mean that our stock that initially went out is going to come back to us. So if it comes back to us, isn't that going to increase our asset of stock? Yeah, it would. So that means that sales returns should have a debit balance. So I'm going to highlight that pink. And then in the same instance, right, when we talk about purchases returns, this is if we take stock from a supplier and we probably don't want it or it's damaged, and we're going to send it back out. Right? It's going back out to the supplier. We're returning things that we purchase. So that's going to represent a decrease. Everybody agree with that? So decreases in assets should have a credit balance. So I'm going to highlight that orange. All right. So we have just identified by using a little bit of logic and rationalizing it that our sales returns balance should be a debit balance and our purchases return balance should be a credit balance. Everybody understand that? Yeah, good. So that's one way. Now, when we approach accounts in this manner, then it helps us to understand and we could work things out without having using our basic or foundational concepts of understanding of accounts, right? So that's why the foundation is always important in accounts, and I stress that with my students, right? So that way you're not trying to commit to memory. Well, the sales thing's supposed to have this written, and the purchase is supposed to have this, right? Because sometimes you might get flustered, you might be tired, and you just can't remember. But if you understand and you could say, all right, well, Sales returns means that the stock is coming back to me, and stock is an asset. And if it's coming back to me and it's increasing, and assets is debited when it's increased, then that means my balance should be a debit balance. So we don't need to learn that. We understand it. So it's easier for us to remember. Good. So both sales and purchases returns, we identify them and we know that that's going to go in our trading account. Electricity charges, now that's a expense. So that's going to go in our profit and loss. And so is telephone charges. So my first step in approaching this question, I haven't started working anything as yet. I haven't drawn a balance sheet or trading on profit and loss, was for me to just get familiar with the figures that I have on the paper. And this is important. It's important to practice this from now, because even if you continue with your studies in accounts, this is the best way to approach any question. You're making sense of all of the figures that is in front of you, so you know exactly where these figures are going. You are going to reduce the likelihood of missing a figure and not including it where it needs to belong, and it's going to increase your chances of using the figure in the correct place. Next, we're going to go to the notes. So we need to see what we have taken place in the notes and any adjustments that we need to make. Now, remember I told you at the beginning, the stock that is quoted inside of the notes is usually our closing stock. So I use CS to represent closing stock. Now here, look at this one. This one is saying that expenses to be accrued. Now, what's our understanding of accrued? Accrued means owing, right? Accrued means owing. Now, why is this accrued and this prepaid thing important in any way when preparing the profit and loss, trading and profit and loss account? Well, in accounts, there's a principle or concept, right, that we call the accrual concept or the matching concept or principle. Basically, what that means is for us to accurately determine what our net income is for a period could be a year, a quarter, half a year, biannually, right? We must match all of the expenses that occurred in that period against the revenue that we earn in that period. That way, right, we could say, well, the net profit for this period was this, right? If we don't do that, it means that we are carrying some of the expenses that was incurred during this period, that probably was a result of the sales that was done in this period, to another period. So we skew in the profits, right? So it's not proper practice. It's not good reporting. Remember, at the end of the day, the purpose of doing this entire thing that we call principles of accounts is to be able to provide financial information for different stakeholders, your managers, the investors, the bank. And if you are not providing information that is accurate, right, or accurately reflects the position of the business in a particular period, then that is going to skew the decisions that will be made. For example, here we are saying that expenses to be accrued or expenses accrued was office expenses $215 and wages $720. What that means, as I said, accrued is owing. It means that we are still owing $215 in office expenses, and we are still owing $720 in wages. Now, if I don't make any note of this and I don't make any adjustments for these two things, it means therefore that the office expense that I will be reporting here and the wages expense that I will be reporting here will be what we call understated. It will be less than what it actually was. And if it is less than what it actually was, I mean, we could just think of a small scenario. Let's just say our gross profit was $1,000 and our salaries, I'll just use salaries for now, right? We put the salaries at 300, right? So if I put at 300, then that means I just using a very generic example. Let's assume gross profit is 1,000 and the only expense you have is salaries. So if I take away salaries from the gross profit, my net profit is 700. But let's just say I was owing $200 in salaries and I didn't put it in here. If I did put the correct amount, even though I haven't paid it as yet, I am putting it so I could report accurately that my net profit is really 500. If I didn't put it and I report that my net profit was 700, then the management will say, well, we have $700 in net profit. Maybe we could do this or maybe we could do that, right? They will make a decision based on $700. And then let's just say they use the majority of the money. And then 2 weeks after, well, the workers need their money, right? And they say, but how, where we going to get the money to give them, right? This is a hypothetical situation, right? We do have the money or we use it up or something, right? So it's important for us to report the amount of expenses that occurred, not necessarily what was paid, but what occurred during the period. We must match that against the revenue for that period, right? So that we can accurately report what our profits or losses would be. Give me a thumbs up if you understand that. All right, everybody good with that? Good. So now that we know this, right? This was just a little side note here, right? Now that I know this, we're going back to my process of tackling these questions. I will automatically come here now. I'll go back. If this was my exam paper, I'll go with my pen or pencil or whatever. And office expenses, I'll look for office expenses. Here's office expenses. And I need to add, because I'm saying I'm owing, 215. So right next to the figure, I will write 215. Right? And next to salaries and wages, I will write 720. So I will remember that I need to do that. Now, I ain't really adding it up as yet, right? When I come to working now, when I usually would have a space for working before I write up, I'll put 1 so I could identify the working by number. And I'll title this office expenses. But there's no real format, right? Just using what feels comfortable. This is just to help you identify and help the examiner know, well, all right, this is what you're working out here. They're not just going to see random figures held hostage on the paper and they don't know what it is about. Right, so I do this 4,760, just get on calculator, 4,760 plus 215, it's 4,975. Right, so I know that's the figure I have to use in my income statement. Next are the salaries and wages. $57,809 plus 720. That's 58,529. Right? So we already have our working for this first, well, second note. The next thing is depreciation. They say depreciation or depreciate fixtures at 15% on a reducing balance basis, right? Buildings, $5,000. So I'm not seeing a figure for fixtures on the list of answers. Did they leave something out from this? All right, so I'm just going to make up a figure, right? Yeah?
Oh, two pictures.
Yeah? Tell me.
I sent you 2 pictures.
Oh, there's another one?
Yeah.
All right, just now. Let me go back to
But then there's when it says fixtures at plus, and the number for that is 8,200.
Okay. Right, I've seen it, yeah. 8,200 and provision. Okay. Okay. All right. Let me just cut that out on all of them is for the same question.
Yes, sir.
Okay, no problem. I want to go across the page. So all right. Good. So here's our fixtures. So our fixtures at cost. Let's talk about this one. Now, when I say using a reduced balance basis, you always take the original cost of the fixtures, which is 8,200, right? Everybody see now here? And then this provision for depreciation is the total depreciation that has happened to date, meaning that so far in the useful life of fixtures, we have already accounted for $4,200 in depreciation. So this is provision for depreciation, and this is to date, right? 4,200. What's that? Right, so this is to date. So if I subtract this $4,200 from this 8,200, I remain with 4,000. This is what we call the net book value, meaning that's what the current value of fixtures is as at this particular point in time. So when we say we find a depreciation on the reduced balance, this net book value is actually the reduced balance. So we have to find whatever percentage they give us for depreciation, 15% on the reduced balance. So I am going to take this $4,000 here and multiply that by 15%, which is 0.15, and that should give me 4,000 by 0.15, $600. So this figure here is a P&L figure, right? You have to remember we need to put this inside of our profit and loss section. So what I would do is I would usually go back right next to the notes, and I'll probably put a line or arrow here stating that my depreciation charge is $600. So I don't forget that I need to include it. Building, it seems that building is being reduced on what we call a straight line method, meaning it's a fixed amount every year. So you see here that the cost of the building is 210,000, but then you're seeing that it's actually 160,000. The difference between those two figures will represent what the building has depreciated by so far in its useful life, right? That's what 50,000. 50,000 is how much is depreciated so far. But this year's depreciation for this particular period that we're doing our income statement for, right? Our depreciation for building is 500. So this is another P&L figure that we need to make note of. And I put all these things in my working so I don't forget. So this is provision for depreciation building. talking $5,000 of pounds, right? This one here was provision for depreciation fixtures. Everybody with me so far? Nice. So the next one, number 5, we want to talk about provision for bad debts. They say reduce it to this amount. So currently, what is it at? It's at 1,400, and you want to go down to 250. So we're at 1,400, and you want to reduce it to 1,250. So what's the amount that we need to reduce it by? If it's at 1,400 and I want to go to 1,250, then it means that I have to reduce it by 1,400, probably 150. Yep, 150. Now the thing about the provision for bad debts, we only record either increases or decreases in a provision for bad debts inside of the profit and loss account. Unless it's the actual first time that we create any provision where we'll put the full amount, every time thereafter, you will only record the amount it changed by, it fluctuated by, meaning that if they said, well, all right, we were at 1,400 and it increased to 1,500, then I just need to record an increase of $100. That's what I'm going to be recording in the profit and loss, not a whole 15. If we are saying in this particular question, we are reducing it from 1,400 to 1,250, then we just need to report or record the reduction of 150. Now check this out. To increase it, we treat it as an expense and we subtract from gross profit, just like all the other expenses, rent, salaries, right? Office expense, you're decreasing, you're subtracting those things from your gross profit. With the provision, if the provision increased, so if we said it was 1,400 last year, now we're going up to 1,600, so it increased by 200, we will just charge $200 as an expense, right? And that'll be subtracted from the gross profit. The opposite happens when we are decreasing the provision. If we are decreasing the provision, we treat it like a form of income. And instead of subtracting, we add to gross profit. Right? So you will add this increase of $150. This has to be added to my gross profit. Give me a thumbs up if you're okay with that. Everybody all right with that?
I'm a bit confused.
No problem. So let me look at it on a separate page, right? So there are 3 scenarios for provisions for bad debts. You have scenario 1. This is where it's new and we are creating it. Then we have scenario 2. This is where we increase it. And then scenario 3, decrease it. So where provision for bad debts, what's this all about? Why are we actually doing this? Well, there's always a likelihood in business that when you do business on credit, when you offer goods on credit, sell goods on credit, meaning that you give people the opportunity to use goods, access a service, and then pay for it after they've received the goods or access the service. there's always a slight possibility that some people you will be unable to get the money for the goods or the services that I provided, right? That's basically a bad debt. A bad debt is where you have a debt and you're unable to recover the money that is associated with that debt. So some businesses they try to be a bit prudent, right? So as not to overstate their profits, they want to kind of anticipate that. All right, yeah, we have all this money outside, but if we report it as we have $10,000 in debtors, chances are we know very well that $1,000 out of that 10,000 we ain't going to get back, because you might have heard through the grapevine that this particular business struggling, or that person that was supposed to pay us they get laid off, or they have a family member that's not well and their priorities have shifted to dealing with that and is using a lot of their finances. A lot of things can happen, right? We don't need to try to figure out what causing it. What we do know is that there's a chance that some of these debts that we have could go bad. Agreed? Everybody agree with that? So what we do is we provide for bad debts. We say, all right, here what? If I have $10,000 in bad debts, let's just anticipate or assume that maybe 2% of these debts we will never be able to collect, right? We're not going to get that back. So you're kind of providing for the likelihood of it. Now, if you get it, well, all well and good. But if you don't, you know, well, all right, I've already expensed from my profit that there's a possibility that 2% of this 10,000, which is $200, is irrecoverable. I'm not going to get it, right? So that's creating a new provision. When we create a new provision and we say, well, we're going to find 2% of this 10,000, that's 200. It means in my profit and loss account, I am going to debit it, right? When I say debit it, it means that you're going to put it as an expense. And expenses are taken away from gross profit, right? You'll remember that. Let me just switch back here. So check this out. Remember, after I find gross profit here, I either add income and then I could subtract expenses. Like all of these things here, expenses, carriage outwards, discounts allowed, loan interest, office expense. You subtract those from gross profit. So when I create the provision, I am going to treat it as an expense. And I will subtract from gross profit like all the other expenses. So in this case, the double entry for this will be, I will credit my provision for bad debt and I'll debit the profit and loss account to create the new provision, which is 2% of 10,000 to create $200. Give me a thumbs up if you're okay with that. Right? So let's say that this was year 1. So year 2 come around now, in year 2. And guess what? We're maintaining our 2% provision. But let's just say this year we have $15,000 in bad debt. Not in bad debt, sorry, my bad. We have $15,000 in debts. So what changed? My 10,000 debtors is now 15,000. The provision is still 2%. But when I find 2% of 15,000, what am I going to get? 15,000 by 0.02, that's $300. So check what's going on now. My provision, or the amount that I need to provide for provision for bad debts, went up from 200 to 300. Now, the rule is in the profit and loss account, we only record the amount it increased by. So if it increased, I already had 200 last year, and I have to go up to 300. It means that I just need to expense 100. Everybody okay now?
Can you please go over that one more time, please?
Right. So in year 1, total debtors, this is total debtors, is 10,000. In year 2, the total amount of my debts or total debtors is now 15,000. So when I find 2% of 15,000, my provision for bad debts, the amount that I'm going to have to provide for bad debts, is now going to be 300. You okay with me up to there?
Yes, sir.
Right. So to go from 200 to 300, I am increasing by $100. Agreed? Yeah? Right. So if I'm increasing by $100, I am not going to put this entire $300 inside of the profit and loss because I've already provided for 200 last year. I am just going to charge what the increase was, which is $100. I'm only taking out inside of my profit and loss account. I am only going to be expensing $100, which is the increase. So after we have created the provision for bad debts, the rule is we only record or account for the increases or decreases. You're not going to do a full amount like 300 or again, if we started in 1 year and we set it at $200, because check this, right? The thing about provisions is that it's not really a cash transaction. It's not like you take money and you went and pay the rent. You understand what I'm saying? It's a non-cash item. You follow what I'm saying? It's not like you literally take $200 and you pay this thing. That's what I mean to say. Think about it. That makes sense to you guys? Like, let's compare it with salaries. With salaries, if I pay the staff, let's say I pay $10,000, say staff, I am literally going in the bank, taking $10,000 out of the bank and go and distribute it. That's gone. There's no $10,000 there inside of the bank account. But this thing called provision for bad debts and this thing called provision for depreciation is a non-cash transaction. There's no me withdrawing money from the bank and going and putting it anywhere. You just charging money to your net profits and saying, hey, that's you say using my car at the building, $5,000, right? But you didn't really spend five. It's not like you spent $5,000 on the building, right? It's separate from like building repairs. If you did building repairs, you actually would spend money in the building. But here, just depreciating with provision for bad debts is not that. Now, there's a difference between provision for bad debts and a bad debt. If somebody really didn't pay, you know they didn't pay, and you have to write off for that, you will write it off. And we have that listed as a bad debt expense. But this 200 and 300 we're talking about is just you anticipating that the debts will go bad. So you are charging yourself an expense for that really did not occur. Right? So this is why we are only recording the increases and decreasing, because then you will be overcharging yourself if you think about it. That makes sense to you? Does it clear it up a bit, or tell me if I move a little too fast there? Give me a thumbs up if you're okay, if you understood what it is you're trying to say. Sarah is good. Odlin, you good? Samantha? Everybody? Monica, you all right? You okay, right, Monica? So based on what I just said, we are not going to write the 300 inside of the profit and loss account as an expense. We will only record the $100 it increased by. And similarly, if it decreases, let's just say in the following year, a lot of people paid their debts. So we do have a lot of debtors in year 3. Let's just say it went down to $6,000 in terms of total debtors. So total debtors in year 3 is 6,000. We're still charging 2% of total debts as our provision. What are we going to get there? $120. So now we went from 300, because that's what it was before, right? Down to 120. So 300 minus 120 is a decrease of 180. So I am not going to write 120 inside of my profit and loss account. I have to write the amount that it decreased by. And since for the other times where it increased, we charge it as an expense. Now we're going to treat it like a form of income because it's like a savings, right? We do have to charge this amount. We will credit the profit and loss account and treat it as an income, the opposite of an expense. And we will write the amount that it decreased by. It went from 300 down to 120, and that's given us 180. So I will add to my gross profit $180 instead of subtract from it as I was doing before. Everybody clear now? Yeah. So everybody know what to do. Everybody understand and know what to do provision for bad debts now. So we're back to our original question. So with our original question, this 150 we're going to be adding to gross profit. Cool. Next thing we got to do is now another thing that I told you, I didn't tell you guys, is as I do these things, the working for these, I'll just kind of tick it off so I know where I completed that. And when I use the figures, I also scratch them off on my question paper in exam. So I know, well, all right, I did that. Right? You gotta kind of audit yourself. Otherwise, it's easy to make mistakes. At least that happens to me. Right? So I have the checks and balances to prevent that. So next we have electricity. And that's prepaid. Now the prepaid is the opposite of owing. So just like if we owe in, we still need to add the amount that is applicable to this period. If I prepay electricity, which is money being prepaid or money being paid for electricity bill that we have not yet received, this is in the future, right? We haven't gotten to that period as yet. So I can't report for it in this current period because I'm going to be matching an expense to income that has not yet been earned, right? If we prepaid electricity for $2,000 for next year, then I have to put that against next year gross profit, not this year profit. This year profit, we only put in this year's expenses against this year's profits. So with that being said, I have to subtract $2,000 from my electricity. So I will come back here in my working now and I will say 6,000. Was it 6,000? 6,600. 6,600 minus 2,000. That's full 600. So this is the amount that I will be putting inside of my trading and profit and loss account. And I take that off. Right, let's just check these other set of figures on this side. Right, well, it's the same set of figures. Let's just make sure we're not missing anything for inside of our profit and loss account. So building at cost is our balance sheet item. I'll put BS next to that. So is this, right? This part of provision for depreciation I will be using in the balance sheet because the other one that I did was used for my trading account. That's this here, right? This is total provision for depreciation. So this is not from a profit and loss account. This is from a balance sheet, right? So we can show the net book value inside of our balance sheet. This figure here is also balance sheet. This is my total debtors, total creditors. This is balance sheet here, right? This got 2004. That is our opening stock, right? Anything inside of the balances is our opening stock. See it here, 62,740. Sales, we saw that was trading, purchases, trading, carriage and sales, profit and loss. This is profit and loss, profit and loss, profit and loss, profit and loss. Bad debts. This is an expense for profit and loss. Provision. This was last year, the provision. Loan is going to be in my balance sheet. Capital is my balance sheet. Drawings is my balance sheet. Sales and purchase returns is profit and loss. Electricity charges is profit and loss. So we know where all of our figures will be going. Everybody okay with that? Yeah. Now that we have done all of this preparation for our trading and profit and loss account, we could now get into actually doing up the trading and profit and loss account, right? So I've already started kind of drafting up some of the things that we need to put in here. So I like to use 3 columns. The purpose of the columns in the trading and profit and loss is just to kind of give you a bit of columns to work with, right? So working columns. The final column is like a total column. So this is where you're going to put your total balances or things that don't need any kind of adjustments in. And these two are like little working columns that you use. So sales and sales returns could go in my final column immediately because there's not a lot of adjustments to make there. So total sales figure, I'll use this set of balances on the side, right? Move this out to the real bit. Is 368,411. 368,411. Maybe we could bring this a little closer. 368,411. Sorry about that. Right. And our sales returns, we said was 4,300. Right, so 368,411 minus 4,300. That's going to give us 364,111. Right. So this is our net sales figure. Now, in order to get our gross profit, we need to subtract from our net sales our cost of goods sold, right? So that's what we want to work out here. So this here in blue is our heading, right? This is our heading. This part that we have underneath here is what I'm going to do to work out what the cost of goods sold is. So cost of goods sold is really our opening stock plus our net purchases minus closing stock to give us our cost of goods sold. So we saw that our opening stock was 62,740. I'll put that here in the second column, 62,740. But because I have to do all of these things here with purchases, I will work that in this column here so that I could eventually get net purchases that I could add to the opening stock here. All right, so purchases, I think we need to go across. Total purchases here was 210,000. So 210,000. Purchase returns, well, if you return, that means you need to subtract that, right? Because you don't have that anymore. Purchases return was 6,900. And then we will add carriage inwards. I don't believe we had any carriage inwards. That's like transportation in. We only had carriage outwards. Let me check the other list of balances. Um, Carriage on sales, no carriage on purchases, right? I usually, when I do my formats, I write everything. So if I do have any carriage inwards, I'll just put a dash there, right? What that helps me to do is to learn my format. So I know as I continue practicing doing these questions, I will know what my format is. I'll know what to look for. So you could work that out. 210,000 minus 6,900. That's going to give me 203,100. Notice that I'm bringing in net purchases now to add to my opening stock. And that's going to give me my goods available for sale. Remember we talked about that last class? So 62,000 plus 203,100. That's going to give me 265,840. So if I had 62,740 at the start of the year, and then I purchased 203,100, in total, I have available to sell $265,840 worth of goods. If at the end of the year, my closing stock is 74,210, I have to subtract that. It means that the cost of goods sold will be the difference between these two figures, right? If I remain with 74,210, it means that what was sold will be 191,630. 191,630. And that's what I'm going to take away from my sales. 191,630. Because when I subtract cost of goods sold from sales, that's similar to like in math when we say selling price minus cost price is equal to profit, right? So we have 364,111 minus 191,630, and that's 172,481. 172,481. Now we need to add any type of income, right? Well, what we have is not an income, but we have a decrease in the provision for bad debts. See? Now, when you approach the question like this, it's easy for you to know what I'm going to be writing or what I need to put inside of my statement next. I have to put 150 here. Right, so we could add that. That's what 1, 8 and 5 is 13, 4 and 1 is 5, and 1, 6, 2, 7, 1. Right, next we have all of our expenses. So we could use the middle column because there are no adjustments ready to make on these, right? Carriage outward on sales. Let's just go here and look for some figures. It's 3,410. And remember, I have some adjustments to make on some of them. 3,410. Discounts allowed was 620. Loan interest 3,900. Right. Always just take a peep at your notes. Right, remember we had the office expenses. So I have to go to my working to see what's my office expenses value. 4,975. 4,975. right? What 760 plus 215. What you could do is 4760 plus. So just write the weekend next to the expense, like where if you had to add on, easy for the examiner to see, all right, this person know what they're doing. 57,829 plus 720. And that figure is 58,529. Right? Let's go back and see what the expense is. We could deal with the provisions one time, right? Or we could do the others. We have bad debts, provision for bad debts. We dealt with that already. Let's put the bad debts figure 1632. Right? So as I do these in exam, this is what I'll be doing, right? As I use the figures, I'll be scratching them off. So I'll scratch this, scratch that, right? We did this, we did this, we did office expense, we did salaries, um, we did bad debts. I can't remember if we do loan interest. Nope. Let's do that one time. Now, these are foolproof ways of approaching a question, right? Believe it or not, I used to make plenty of mistakes. So I came up with these strategies to help prevent me from making a lot of silly mistakes and throwing away marks and getting them wrong. Right? And helps with the understanding as well. And then when you practice doing all the questions like this over and over and over, then it becomes like a reflex action. Right. So we dealt with all of those. We have the provision for about doubtful debts. We dealt with that too. Right. Remember, we had to add that. We dealt with sales and purchase returns. This was actually a trading item and not
Sir, you already have the interest.
I have it already. Yeah?
Yeah.
Yeah. That's it already. Electricity charges. I don't think we dealt with that one. I have it twice. Good looking out. Electricity. This one, there's a prepayment, remember? 2,000 prepaid. So we have to subtract that. Electricity was 4,600. And we have telephone charges. So it's 7,800. Right? So we didn't do provision for depreciation for fixtures, no building. So once you have provision for depreciation for multiple assets, you can just write provision for depreciation and then you just do like a dash like this. To put both of them in, right? We did our working. Well, we know the building is 5,000 and fixtures was 600. We put 600 5,000. Yeah. And I think we are fine. We have all of these here. We did this, this, this. Double check. We did this, we did this, we did this, we did this, we did this. Yeah. Everything else remaining now should just be balance sheet items. So now that you know you have all of the expenses and anything that we had to add to our gross profit, we could total up those expenses now. Right, so that's total. 3,410 plus 620 plus 3,900 plus 4,975 plus 58,529 plus 1,632 plus 4,600 plus 7,800 plus 600 plus 5,000. 91,066. So I draw a line here, and then on this side I put 91,066. Remember, that's going in a bracket because I need to subtract that from my gross profit. So 172,061 minus 91,066, 81,565. And this figure here is what we call our net profit. In some instances, some books would say net income. And this, everybody, is our completed trading and profit and loss account with working and your approach to the question. Any questions on what we did? Anybody? No? Give me a thumbs up if you're okay with it. Yeah? Is it clearer to you guys now? Everybody said they had some issues with the with it. Is it clearer now? You understand how to approach it? Yeah? Okay. Now, the trick is, I'm gonna download this whiteboard and send to you. Now, the trick is to always do the questions or your approach to the questions the same way all the time. So it becomes somewhat of a reflex action, right? So what I just did is the same way that I've been doing this since I was probably in secondary school like you guys. So that's a little over 20 years, right? And you'll notice that I don't really use a textbook or anything, right? These things, from repeatedly doing it the same way over and over and over and over and over, it's just going to stick with you, right? Because you try not to vary your method in terms of how you're doing it. So the approach to these questions, even when I change topics and I'm looking at something else, you know, it's the same way. I always try to figure out, what is this figure for? Where does this figure have to go? How does it fit into the larger whole, right? And try to understand, you know, how the approach is rather than trying to learn a format. You know, sometimes you'll be in a class and they tell you, hey, you need to learn the format. Yes, you do need to learn the format. You need to know what's in the account. But if you understand how it's structured, then it makes learning the format a little more meaningful as opposed to just, you know, like how we learn our timetables and things like that by rote. Right? It's a bit different to that, right? So that's my suggestion with approach we approach to these questions. All right, so I'm gonna stop here for tonight. I'm not going to go any further.